Regulatory risk and management of regulatory risks. Welcome to the Risk Management of Everything channel. On this channel, you will see videos on risk management and the application of risk management to diverse areas and sectors. If you are new here, make sure to subscribe to our channel and press the notification button so you can be notified when we upload new videos. Thank you. This video discusses regulatory risk and the management of regulatory risks. In this video, you will understand the meaning of regulatory risk, the importance of regulatory risk, the difference between regulatory and compliance risks, business regulatory risk exposures, regulatory risk management process, increasing regulatory risk due to regulatory changes, mitigation of regulatory risk with the integrated compliance management approach, integrated compliance management framework, the meaning of regulatory compliance, consequences of poor regulatory compliance for organizations, and importance of regulatory compliance. Now, let us start. What is a regulatory risk? Regulatory risk is the effect of a change in laws and regulations that could potentially cause losses to a business, sector, or market. Regulatory risk is the risk that a change in laws and regulations will significantly impact an institution. Regulatory risks arise from laws and regulations that rely on penalties or sanctions to regulate the operations of a business. A change in laws or regulations enacted by a governmental or regulatory body can dramatically increase the costs of conducting a business, decrease the attractiveness of an investment, or change the competitive landscape. Regulatory risk is the possibility of changing regulations and laws that might affect an industry or a business. Importance of regulatory risk. A regulator is responsible for enforcing the code of conduct and principles set out in the relevant regulation. Regulators may issue enforcement action if organizations do not conform to the required standards. Enforcement can include financial penalties, withdrawal of license and imprisonment. Changes in regulations can make significant changes in the industry framework and changes in the cost structure. For example, regulatory risks arising from climate change concerns include 1. More vigorous disclosure requirements regarding a manufacturer's emissions and 2. The emergence of minimum performance standards tied into energy consumption and greenhouse gas emission controls. Business organizations should manage regulatory risk effectively as it could result in 1. Increase the costs of running a business, for example costs to achieve compliance. 2. Change the competitive landscape, for example perhaps invalidating a firm's business model. 3. Make business practices illegal, for example new law changing rules on marketing. And 4. Reduce the attractiveness of an investment. New and emerging regulations can significantly impact a firm's strategic plan, business model, and compliance system. For example, a company's products or services could become less marketable if new laws or taxes become operational. This was the case with tobacco and asbestos products in the past. The introduction of stricter food labeling regulations has similarly disrupted the food industry, pushing up costs and reducing the appeal of certain types of food. Hence, it is essential to consider regulatory requirements when evaluating business risks. The difference between regulatory and compliance risks. Compliance risk is associated with failing to meet regulatory or statutory compliance with policies or rules set by government or industry/sector regulators. Regulations are rules made by an authority or granted to an authority to control industry, process or sector. Regulatory risk is the possibility that changing laws and regulations will significantly impact an institution. Compliance is the outcome of adhering to a rule. Compliance risk captures the legal and financial penalties for failing to act under internal and external regulations and legislature. The critical difference between legislation and regulation is that legislation refers to laws that have been or are being enacted. In contrast, regulation refers to the process of monitoring and enforcing the law. For example, the Data Protection Act 2018 is the primary legislation, and the General Data Protection Regulation, GDPR, is the central regulation that governs data protection. Compliance risk does not discriminate against business type or size. Instead, it requires necessary processes to protect customers and businesses. Failure to do so can result in unwanted and potentially detrimental effects. Companies must abide by regulations set by governing bodies that oversee their industry because a change in regulations will impact the industry. Regardless of the approach employed, organizations should effectively manage regulatory and compliance risks. This is essential to ensure that business organizations, large and small firms, are well managed. Compliance risk does not discriminate against business type or size. Instead, it requires necessary processes to protect customers and businesses. Failure to do so can result in unwanted and potentially detrimental effects. Business regulatory risk exposures. Businesses are facing numerous regulatory risks, including 1. Data protection and privacy. Data protection and privacy are significant regulatory risks businesses face. This is obvious as the new General Data Protection Regulation that came into force on the 25th of May 2018 has wholly overhauled data protection laws across Europe. Violation of data protection and privacy attracts enormous fines and penalties for businesses. 2. Senior manager accountability. Accountability regimes are being implemented worldwide designed to ensure staff take personal responsibility and can be held accountable for their actions. 3. Financial crime. Business organizations' prevention and detection of financial crime is a significant challenge and priority. This is because breaches have attracted the biggest headlines and led to the highest penalties, damaging reputation and brand and significant monetary losses. 4. Cyber resilience. Technological change, increasingly digital business models, and interconnectedness between firms make cyber risk a growing threat to all financial services firms. Global regulators are likely to follow the New York Department of Financial Services, which recently launched cybersecurity rules, and set out more explicit requirements and expectations to mitigate the potential impact on customers, financial infrastructure and stability. 5. Fintech. Global regulatory attention worldwide aim to increase the potential benefits and efficiencies of financial technology. Global regulatory collaboration and sandbox initiatives continue to encourage innovation in the sector. In urgent parallel, issues relating to financial stability, money laundering and customer detriment are high on regulators' radars, already evident through bans on initial coin offerings and warnings about cryptocurrencies. 6. Vulnerable customers. A shifting regulatory focus means firms should be treated fairly, but there is a need to focus on customers at the most significant risk of detriment. From product design to communications, firms will be expected to mitigate the risk of financial exclusion, inappropriate advice and poor customer outcomes for the most vulnerable groups who are less able to look after their interests. 7. Conduct and culture. In response to widespread global recognition that culture is the root cause of misconduct in financial services, firms are making progress in defining what good culture means to their business and adapting to cultural changes. Businesses, therefore, face the practical challenge of measuring, monitoring and demonstrating good conduct and meeting new requirements, including individual conduct rules for the majority of financial services employees. 8. Political uncertainty. There is political uncertainty in many countries, including developed and developing nations. With political uncertainty worldwide, firms are engaging contingency plans to ensure they have operating models and authorizations to meet the most adverse potential outcome. 9. Benchmarks. Benchmarking aims to improve business governance and quality assurance. For instance, the new EU benchmarks regulation emphasized new internal and external governance and assurance requirements to ensure the accuracy and integrity of benchmark setting. This would lead to high-profile investigations and fines for attempted manipulation of vital financial benchmarks within EU members' nations. Regulatory risk management process. Larger organizations have a more difficult time navigating compliance regulations. They often hire compliance officers and consultants to determine the appropriate risk profile or establish an in-house compliance department to achieve and maintain regulatory compliance. Suitable compliance management software can ease compliance management burdens and help organizations leverage the positives of regulatory compliance while eliminating or minimizing the negatives. Here are 5 essential steps of a regulatory risk management process. 1. Identify activities and services. 2. Identify regulators and regulatory requirements. 3. Assess risks of non-compliance. 4. Evidence compliance. And 5. Monitor and review the regulatory risk management framework. Now, let us discuss the essential steps of a regulatory risk management process. Step 1. Identify activities and services. The first step of a regulatory risk management process is to identify a firm's activities and services. This will assist the organization in identifying each activity and service, thereby ascertaining whether any relevant regulators set the rules for that activity or service. Many organizations employ compliance and risk management professionals to identify and manage potential violations, thereby ensuring that necessary is maintained for reporting and monitoring purposes. Regulatory compliance software can also help mitigate business risk. Business information databases make it easier to perform due diligence on customers, partners, and other third parties, matching their names with known entities. Such efforts can surface potential issues early on, including money laundering or other fraud attempts. Tracing corporate family trees allows businesses to understand the risk profile of a potential partner and its parent or subsidiaries. Ready access to business data may also allow companies to uncover information about previous regulatory violations by a supplier or customer. Such insights can prevent reputational damage that could arise from associating with these businesses if there is a pattern of wrongdoing. Step 2. Identify regulators and regulatory requirements. Identify regulators based on the organization's sector, industry and operations. At this stage, the critical question is, who are the key regulators? Having identified regulators, the company should establish regulatory requirements based on its activities and operations. Regulators work in various ways, and the organization must be aware of their expectations and any incident reporting requirements. Some regulators may conduct audits and spot checks to review the company's compliance. Others may not routinely engage with the company unless a detrimental issue has been identified, such as a serious complaint, a media report, or a whistleblowing event. Many regulators use principles rather than fixed rules and explicit directions. Principle-based regulation is often open to interpretation, so the company's compliance officers should seek further guidance and clarification if in doubt. It is also necessary to understand the regulator's powers and potential consequences of non-compliance. The company's compliance officers should identify the powers of each regulator and the potential impact if the company fails to comply. These powers can have significant consequences for the organization. Regulators are responsible for monitoring, guiding and promoting best practices. If a charity fails to comply, regulators have the power and authority to impose sanctions. The powers of regulators differ but can include imposing fines, removing licenses, removing trustees, freezing assets and referral to other regulators. Regulators usually publish their findings and actions on their websites, resulting in media interest. To ensure a better understanding of regulators' expectations, it would be helpful to record the following details. Name and overview of their regulatory role and purpose. Understand the powers of the regulators. Understand maximum fines/penalties for non-compliance. What does the company need to comply with, for example code of conduct, fundamental standards, and licenses? Identification of responsibility in the organization for compliance with regulators' requirements. Compliance responsibility should be monitored by 2 or more persons in the organization. The roles may be best undertaken by someone engaged in the relevant business area rather than by someone at the company's corporate office. Develop a process to monitor changes to regulations and necessary action is taken. And keep a log of regulators, their powers, responsibilities, and internal owners. Step 3. Assess risks of non-compliance. The company's compliance officers should assess regulatory risk across the organization and integrate the findings into the firm's existing corporate risk register or other risk management processes. It is necessary to assess the organization's risks not complying with the relevant regulatory requirements. The organization could take a workshop approach to this assessment and involve relevant people with expertise within the firm's business area. This will ensure that the firms capture all regulators that are relevant to the organization. The company's compliance officers should use the existing risk management process and risk assessment criteria to assess the company's compliance risk exposures thoroughly. Record the likelihood of a regulatory risk occurring and the impact if it were to occur and record the assessment. Step 4. Evidence compliance. An organization should develop a demonstrable process to evidence compliance. The organization must demonstrate that it complies with regulatory requirements. The company could undertake a gap analysis to identify where the company might have insufficient evidence to demonstrate compliance. The evidence gathered and data collected should be updated, tangible and robust. It may be helpful to refer to a requirements cell list for each regulator and then identify how the firm can demonstrate compliance. This process will help identify gaps, including training needs, policies and improved internal controls. This will enable the company to take action to close any gaps and agree with ownership of actions and due dates. The action plan should be well articulated and address all potential compliance risk exposures of the organization. Step 5. Monitor and review the company's regulatory risk management framework. It is important to note that regulatory risk assessment should not be a one-off event. Events such as acquiring new companies, movement into new geographical or sector markets, corporate reorganization, and engagement with new customers and regulators will raise regulatory risks. Similarly, changes in regulations and how enforcement authorities interpret these risks can create new compliance and regulatory risks. This is necessary to ascertain whether the company's regulatory risk assessment is current and adequately reviewed. It is essential to implement a deliberate, recurring process to periodically update the company's regulatory risk assessment. Increasing regulatory risk due to regulatory changes. Governmental and regulatory bodies often enact new regulations or update old ones. Regulations can increase operations costs, introduce legal and administrative hurdles, and sometimes even restrict a company from doing business. Here are some examples of regulatory changes that may affect companies or industries. 1. Tariffs and trade policies. Changes to international trade policies may affect companies that regularly export and import goods. They also affect investors that engage in foreign direct investments. For example, conducting business in China is often restricted by trade policies. Western businesses can only operate in China through partnerships and joint ventures. Investing in Chinese stocks is also restricted. Historically, foreign investors have only been allowed to invest in B shares in USD. A shares, which was in Chinese renminbi, RMB, have typically been restricted to domestic investors. This was changed with an announcement in July 2018. In July 2018, China announced intentions to allow individual foreign investors access to A shares through domestic brokerages. In this case, the regulatory change was beneficial to individual investors. 2. Tax policy reform. Tax policy reforms can affect the bottom line for businesses and individual investors alike. Any change to income tax law directly affects the income brought in by respective parties and may present new regulatory risks. 3. Minimum wage laws. Increases in minimum wage can be a critical source of regulatory risk, as they substantially impact businesses, especially if they hire large quantities of low-skilled labor. In particular, small businesses suffer more significant losses due to their inability to access economies of scale. 4. Mandated vacation and sick days. Similar to the above examples, changes to mandated vacation or sick days affect a company's bottom line as they are required to give employees more time off. By allowing employees to have more vacation days, they will be less burnt out and more productive during days in the office. Stress-related issues can be alleviated by allowing more vacation days. Office productivity may also increase because employees keep illnesses out of the office by allowing employees more sick days. Sometimes regulatory changes can benefit investors or companies. Companies may be penalized if they do not comply with regulatory changes. Businesses need to pay attention to and manage regulatory risk by ensuring compliance and diversification in their operating strategies. For example, in the case of diversification, a company can protect itself from trade policy changes with any particular country by diversifying its market into multiple countries. Mitigation of regulatory risk with integrated compliance management approach. The complex regulatory landscape that organizations are required to adhere to has been increased due to the global pandemic. The growing focus on data privacy and protecting the rights and interests of customers and key stakeholders has resulted in a flurry of global, national, and state regulations. In response to the increasing number of national and regional regulations, businesses, including banks, insurance companies, investment fund managers, and the energy sector, face more significant regulatory requirements challenges. Financial institutions are often subject to regulations concerning disclosure, investment strategies, and liquidity requirements. For example, the alternative uptick rule was a rule passed by the United States Securities and Exchange Commission, SEC, in 2010 to preserve market stability and confidence. The rule ensures that a short sale order must be entered on an uptick, where the price of a security is higher than its previously traded price. It is invoked when a stock's price drops more than 10% in one day and heavily affects how investors who take short positions invest. Government regulations are translated into corporate policies, the foundation of a sound compliance program. With the mounting number of regulations and regulatory updates, ensuring an effective compliance management program has become a daunting proposition. Some organizations are still using the traditional approach, which often results in inconsistent policies, leaving employees unsure about the latest policy. Now, let us discuss the Integrated Compliance Management Framework. Integrated Compliance Management Framework. To mitigate regulatory risk efficiently, organizations need to adopt an integrated approach to compliance management. But how? There is no one-size-fits-all approach to compliance. It depends on each organization's specific requirements, which depend upon several factors, including the industry, the number of regulations it must comply with, the maturity of the compliance program, and the jurisdiction. However, there are certain core elements of a compliance program that every organization follows. Obligatory rule mapping, creating and maintaining a repository of regulatory obligations and mapping them to policies, risks, controls, and processes. Regulatory change management, to identify, track, and analyze regulatory changes and assess their impacts on business. Compliance risk assessment, to identify the firm's compliance areas that are high risk to manage and monitor those high risk areas on priority. Compliance control assessments, testing and continuously monitoring compliance controls to ensure their effectiveness and alignment with evolving regulations, policies, and standards. Policy and document management, to create, update, and align policies with evolving regulatory requirements to ensure that employees, third parties, and partners know the latest applicable policies. Case and incident management, to establish consistent procedures for the case and incident planning and administration, recording, triaging, routing, investigating, tracking, and closure. Compliance advisory, evaluating compliance functions to identify loopholes or gaps, preventing compliance breaches, and devising mitigation and remediation measures quickly and efficiently. Regulatory engagement management, to manage regulatory engagement activities, including examinations, meetings, requests for information, and engagement-related documentation. These processes ensure a typical data architecture and a risk-based approach, enabling organizations to respond to the fast-changing regulatory landscape in an agile manner. Consequently, a robust compliance program is enforced with a culture of compliance across an enterprise. Particularly in the current remote working setup, compliance teams need to be thoughtful and purposeful in building a culture of compliance. A top-down approach is critical to that end. The impetus should come from the executive management and board. Clear policies and procedures, effective communication, recognition, and disciplinary measures will help set the expectations for individual employee behavior in the workplace and encourage a compliant mindset. Companies must abide by regulations set by governing bodies that oversee their industry. Therefore, any change in regulations will impact the industry. Regardless of the approach employed, organizations should effectively manage regulatory and compliance risks. Hence, the need to discuss regulatory compliance. What is regulatory compliance? Regulatory compliance is a mandatory requirement for countries with a robust business and economic landscape for specific sectors and organizations. Regulatory compliance is when businesses follow relevant state, federal and international laws and regulations in their operations. Compliance requirements vary depending on the industry and type of business. Regulatory compliance is essential in industries with sound compliance oversight, such as financial services and healthcare, and sectors where issues like data protection, cybersecurity, and consumer privacy are critical to business continuity and legally compliant operations. Regulation is a law enacted by a governmental body granting a regulatory agency enforcement authority. While government regulation refers to the law, regulate means controlling or supervising using rules and regulations. Thus, legislative and executive branches establish the laws, but government agencies enforce these laws, ensure compliance, and track non-compliance. The implication is that non-compliance leaves companies at risk of security breaches and data losses, and disciplinary action that could lead to license revocations, damaged reputations, lost customers, and financial penalties and losses. A regulatory requirement as written may apply to all organizations who do business in a particular state or country, organizations in a particular industry, or organizations who engage in a particular kind of activity as part of their normal business operations. The United States government includes many regulatory agencies with a mandate to oversee the activities of private companies in their respective industries. These include organizations like 1. The Securities and Exchange Commission, SEC. The SEC establishes and enforces regulations surrounding buying and selling securities in the United States. 2. The Federal Trade Commission, FTC. The FTC establishes and enforces regulations that support a competitive marketplace and protect consumers from deceptive commercial practices. 3. The Food and Drug Administration, FDA. The FDA regulates food companies, cosmetics companies, and drug companies that distribute their products in the United States. 4. The Occupational Health and Safety Administration, OSHA. OSHA develops and enforces workplace health and safety standards, administering hefty fines to non-compliant organizations. 5. The Federal Communications Commission, FCC. The FCC establishes interstate and foreign communications regulations via telegraph, telephone, television, and radio. 6. The Health Insurance Portability and Accountability Act of 1996, HIPAA, regulated the protection of patient information, precisely Electronic Protected Health Information, IFI, and granted the U.S. Department of Health and Human Services, HHS, oversight authority to enforce compliance. 7. Health Information Technology for Economic and Clinical Health Act, HITECH. The HITECH is part of the American Recovery and Reinvestment Act, ARRA, of 2009. High-tech creates incentives related to healthcare information technology, including incentives for using electronic health record, EHR, systems among providers. 8. Payment Card Industry Data Security Standard, PCI-DSS, is a set of security standards designed to ensure that all companies that accept, process, store or transmit credit card information maintain a secure environment. And 9. European Union's General Data Protection Regulation of 2016, GDPR, is a regulation in EU law on data protection and privacy in the European Union, EU, and the European Economic Area, EEA. The GDPR is an important component of EU privacy law and human rights law, particularly Article 8(1) of the Charter of Fundamental Rights of the European Union. It also addresses the transfer of personal data outside the EU and EEA areas. The GDPR's primary aim is to enhance individuals' control and rights over their data and simplify international business's regulatory environment. Consequences of poor regulatory compliance for organizations. Organizations that fail to meet regulatory compliance requirements might face substantial fines or penalties that depend on the exact nature of the offense. Government regulations provide guidance that helps businesses succeed, and failure to comply often coincides with various kinds of business failures. Other consequences of poor regulatory compliance for organizations include suspension or debarment from bidding on government contracts, damage to the organization's reputation as a trustworthy business partner, individual penalties or jail time for individuals who intentionally violate the law, and disruption to business operations caused by investigations or legal proceedings. Importance of regulatory compliance. Here are some of the importance of regulatory compliance for organizations. 1. Financial health. Financial safety is a primary benefit of regulatory compliance. Regulatory non-compliance can result in severe penalties for the errant organization. This is what happened in 2020 to Goldman Sachs, Wells Fargo, and JP Morgan Chase, who ended up paying fines of $7.50 billion out of a total of $11.39 billion imposed on all U.S. banks during the year. 2. Protection from lawsuits. In addition to avoiding financial penalties, complying with laws and regulations protects organizations from lawsuits, whether brought by the agency or someone else, for example, the public. For example, in 2019, between 2011 and 2019, 142 local governments filed lawsuits against businesses for non-compliance with the Americans with Disabilities Act, ADA. 3. Business continuity and competitiveness. Regulatory compliance provides guidelines to businesses on what is required to succeed in their sectors and industries. Compliance laws also evolved to help create uniformity in the marketplace and enable companies to compete fairly, ethically, and on equal footing. Companies that achieve regulatory compliance may achieve a good position in their industry. 4. Maintain a good reputation. Companies that comply with regulations and laws offer consumers a sense of security. They trust such companies with their data, money, and loyalty. 5. Protection from cybercrime. High-risk industries like healthcare and financial institutions recognize the value of the information they collect and acknowledge that they are attractive targets to malicious actors. However, other industries sometimes feel that they are not as likely to be attacked. This mistaken assumption often leads to limited regulatory compliance focus and diminished security, increasing the likelihood of cyberattacks and data breaches. Data breaches reduce customers' retention, which can have a catastrophic financial impact on the company, and even lead to bankruptcy and closure. Regulatory compliance provides added information security by requiring organizations to adhere to rules to protect their assets from threat actors and acts as one of many safeguards to ensure data protection. 6. Improved profitability. Regulatory compliance and the audit reports proving compliance allows companies to market themselves better. One of the most well-known regulations in the United States is the Sarbanes-Oxley Act of 2002, SOX. SOX established stringent rules for U.S. public companies to document financial compliance and corporate disclosures. Its goal is to prevent financial fraud and protect investors and the public. SOX also granted the Securities and Exchange Commission, SEC, enforcement authority and created the Public Company Accounting Oversight Board, PCAOB, to oversee audit rules. SOC 1, SOC 2, and SOC 3 reports help clients trust their vendors and demonstrate ongoing SOX compliance. Without these reports, the business might lose customers and still be profitable. Conclusion. This video has discussed regulatory risk and the management of regulatory risks. Regulatory risk is the effect of a change in laws and regulations that could potentially cause losses to a business, sector, or market. Regulatory risks arise from laws and regulations that rely on penalties or sanctions to regulate the operations of a business. While compliance risk captures the legal and financial penalties for failing to act under internal and external regulations and legislature, regulatory risk is the possibility that a change in regulations or legislation will affect security, company, or industry. Companies must abide by regulations set by governing bodies that oversee their industry. Therefore, any change in regulations will impact the industry. Regardless of the approach employed, organizations should effectively manage regulatory and compliance risks. This is essential to ensure that businesses are well managed. I hope this video is educative and beneficial to you. Please post your comments below in the comments section. If this video has been educative and beneficial to you, then give it a thumbs up and share it with your friends. Thank you for seeing the Risk Management of Everything videos. We love to hear from you. Please post your comments and questions in the comment section down below. If you are new here, make sure to subscribe to our channel, Risk Management of Everything channel, and press the notification button so you can be notified when we upload new videos. Thank you.